Good morning, this is Ken Long at Tortoise Capital with a review of the weekend trading report for August 11th, 2017. The market is in bullish normal conditions, still overbought on an annual basis with NDX 260, oversold on a 10-day basis with NDX 10. Price relative to the 200-day moving average is green bullish at 4.38. Slope of the 50 went got negative this week at 0.12%, yellow bearish. ADX is a weak 11.0 for trending. Risk index is the 30 period moving average of the VIX divided by the 10. 1.0 is the boundary between risk on and risk off. It's currently reading at 0.904 risk off. Finding that risk Z, we take the number 0.904, look back 5,000 trading days, find the average and standard deviation, and compute the risk Z. It's at minus 1.18. So 1.18 standard deviations below the long-term average. This is a 90-day histogram of that indicator. We have been declining and then dropped off the edge here, and so we are in risk off. This favors day trading only. It's not until we see the market bottom out on volatility and start to improve that we can think about getting long again with swing trades in bull markets. You see here the blended monthly rebalancing holdings until 1 September. These are the holdings as of close on Friday. In ETF2, the theoretical exposure actually drops off to 80% rather than 100%. Model portfolio remains at 100%. These are the blended monthly rebalancing ETF portfolios. You can see we're starting to see some cash positions creep in and even some give backs in the leading candidates. Only treasuries did well this week. Gold and treasuries did okay in the ETF 32 along with various bond symbols. Just notice that even the front runners, the ones with the best blended numbers, are still vulnerable to sharp 1 week pullbacks. In ETF Max, these are the ones that have the greatest gains, and we've added the 1 week and 1 month. This is a price anomaly here in IGE, disregard that. In the S&P 500, we'll be looking at some momentum winners and losers. Among the relative strength winners long term, I like to look for 1 week and 1 month exceptional outperformance and underperformance. So these top four are ones that look to me like there may be some more short-term momentum available. Here's one like, for instance, H&R Block pulled back on the 1 month, but now has started to resume, so there may be some gains there. Tesoro, Cognizant, and then these ones that are in the yellow and the red are ones where we may have seen the top already put in, and this is a return to the long-term mean. Market health check. We've seen the big 1 day and then a consolidation day, big sell-off, then a consolidation into a doji. You can see that the 30 period regression line slope has started to roll over. Still positive, but it has may have already peaked here and found strong support at 243.5. So now we'll find out if the Bollinger Band mean holds. Next support levels, really bottom of the river at Z-2 at the floodplain and the belly of the dragon. If that cracks, then look out below. The next two are at 239 or 238.5, 237.5, and then all the way back down to just above the 200-day moving average at 232. You can see the 200-day moving average is now rejoined the chart. Jaws of PPO open to the downside, deeply into channeling conditions. The international markets are dominating. 8 of the 10 indexes are on buy signals, leaving us at 80% invested, 20% cash in the allocation model. EFA at 62 is better than the U.S. large caps at 57, so the global's outperforming. Inside the U.S., it's small caps, tech, large caps, mid caps. Emerging markets and Europe are the two strongest sectors, the U.S. large caps and mid caps are the two weakest. Real weakness here in the U.S. sector spiders, in materials and industrials, healthcare and financials also lagging. Defensive plays and utilities looking like the only joyful place in the sector spiders. Again, you see large caps in the U.S. holding up, mid caps suffering. Europe, all above average, some exceptionally so. Emerging markets in Mexico and Brazil doing well. Hong Kong, Singapore, Taiwan. These are the top winners in the ETF2 lens. We're going to shift to the daily report now. Plenty of channeling signals and lots of swing setups based on that one-day sharp pullback on Thursday. There's a lot of good high-quality setups developing. Lots of dojis on Friday. Disney and United Tech both offering better than 2 to 1 on the auto framer. Lots more to choose from in the ETFs. Some 5DDs, triple screens, 551Ws, which would be attractive that if they could put in a positive day on a Friday going into the weekend, that's promising. So I'd be looking at those. Inverse VIX, 4.7 to 1 on the auto framer. Japan and the NASDAQ all testing out better than 2 to 1 also. In the daily pinch and stretch, these are the ones that their closing price on Friday is the furthest percentage and z-score stretch above their Bollinger Band mean, so the greatest divergence from the longer term mean, expressed in percentages and in standard deviations. The most negative Z stretches are the ones that are the deepest drop from their Bollinger Band mean. You can see the pain in the inverse VIX right now. The small caps, United Tech, and mid caps. The river is very wide. These are ones in the green that how many standard deviations wider than normal, the upper limit of normal, their river width is. So Verizon and Boeing continue to do that. That happens when you've had a 30-day directional move that is very strong. That makes the river get the widest that it can be. And you see Verizon and Boeing are in that category. The most compressed pinch box, we like these because of the possibility for pinches and super pinches and Z3 pinch breakouts. These are tightly compressed rivers, and so Pfizer, Nike, JP Morgan are more than 1.1 up to 1.6 standard deviations below average, so very tightly pinched. The river is narrow, like these for breakouts. The super pinches are ones that combine the quality of at least one standard deviation below long-term normal for the pinch, and all four regression lines are within those pinch boxes, and so they're very tightly compressed. And this is sorted by how tightly compressed those regression lines are, the 10, the 30, the 90, the 270. So there's not much room between them here on American Express, and that means all of those regression lines, which represent the estimates of fair value from different time frames, they all are in agreement about the current fair value. So when you have a combination of agreement across the board in a very tightly compressed volatility range, then you have the preconditions for potentially big breakouts as traders begin to move price to new levels. So let's see what AXP looks like on using that logic. So here's that example of AXP. It's super pinched. You can see the Z3 lines have come together quite a lot. And then all of the four regression lines, the 270, the 90, the 30 in the black, and the 10 in the blue, have all clustered together tightly. Just want you to notice that after these kinds of conditions, you get some strong directional moves, very strong directional moves, which lead to reversals and get terrific moves as well. So this is setting up nicely We'll take a look at ExxonMobil and Pfizer as just to reinforce this idea. ExxonMobil, you can see in the same condition, pinch, the breakdown has already started occurring, and you can see that if this support level cracks, it's lookout below. You have to go way back to find the next nearest support level, which we would place right around here. So we're looking at like 75 if this cracks. And then Pfizer. Same condition. The pinches come together. All the regression lines are tightly inside. If this breaks down, we're looking to 32.10, 31.38 based on this level, and 30.44. So again, when you have these pinches, I want you to notice the breakouts that occur can be significant. Here was a pinch that led to a nice breakout. Here was a pinch that led to a breakdown. Here was a pinch that led to a breakdown. Now we've got another pinch setting up with all the regression lines together. So you can see exactly how far price can get from the 270, significant distances, and so that's why we like the super pinch. So that's everything I wanted to cover today. Keep your risk measured and your powder dry.